Hi everyone, welcome to this video on credit risk measurement and management. I am Vivek Sharma. I have made this video specifically for students who are preparing for their CA exams, MBA exams or risk management exam, which may be some of the specialized course like FRM. Let me take you through what is the agenda of this video. So I'm going to discuss five broad things in this video. The first is what is the meaning of credit risk. Then we go on to look at what are the types of credit risk. Further, we understand what are the factors that drive the credit risk. A classification of assets by banks in India. This could be very country specific. Uh, while broad frameworks are put in place by Basel Committee, still, there may be some difference in the approach across countries. We are going to discuss about India. And then finally, what are the types of credit facilities which can be availed from a bank by the borrowers? Because the type of credit facility also define the risk that they bring. With this perspective, let me move further. Many of you would have come across this news. Aircel lenders agree to take 99% haircut on dues worth rupees 20,000. Now, what does this mean? This is a very good example to understand what exactly is credit risk. As you can see here, there was a business or there was a company called as Aircel which had 20,000 crore of loan. It could not pay the loan to the banks, and in the end, there was no option left for the banks but to take a cut of 99% on the loans that they had extended. Effectively, the banks could recover only 150 crore from the loan that they had extended, and the total amount was 20,000 crore, as you can see in this news. Now, this is something which is a very good example to understand what is the end result of credit risk. The end result of credit risk is the loss of the loan extended, as in this case. But is the credit risk always confined to the concept of loans? The answer is a firm no. Let us look at the second example. This is the example of National Stock Exchange declaring a broker Anugrah Stock Broking as defaulter. Now, this is not a banking example. This is an example of a broker who was working on the stock exchange, who was dealing as a broker on the stock exchange. It was an impaneled broker with the National Stock Exchange, and it defaulted on its obligation. This is not just one case. As you can see in this news, at the bottom it says this comes just 2 days after announcing Karvy Stock Broking also had issues, and there was similar credit risk issues that Karvy Broking also had. Okay, so what do we get to know from these two examples? What is it that we get to know? So it's very clear that credit risk is not about just the loans from the banks. It extends much beyond that, and we have already seen this with the help of these two examples. So how do we define credit risk then? It's very important, because these examples indicates in some direction in terms of the credit risk, but how do we define it? So let me pull a definition from Bank for International Settlement, or BIS, which says that credit risk is most simply defined as potential risk that a bank borrower or counterparty will fail to meet its obligation in accordance with agreed term. Now, this definition has a very broad aspect of credit risk. First of all, the credit risk may arise in context of a borrower that we saw just now. Okay, the borrower was Aircel and it could not pay. There can be any counterparty in a transaction who may not be able to pay. So the counterparties in the transactions are not essentially the borrowers. If you trade on the stock exchange, you may be buyer of a seller, so the buyer of a stock, so the seller is the counterparty for you. So whenever you do any deal, okay, there can be a counterparty in the deal. I mean, if you are buying an insurance from an insurance company itself collapses, imagine, okay, then insurance company is the counterparty for you. It will not be able to fulfill the obligation that was agreed upon when you purchase the insurance coverage. So we have to understand that credit risk is a kind of a two-party deal. In a way, it arises from a two-party deal, and in every transaction where there is a credit facility, there is a lender and there is a borrower. Or if it is a transactional credit risk like buying on the stock exchange or selling on the stock exchange, you still have the credit risk which will be existing. Okay, so I hope you are getting the context of what exactly is the credit risk. It's very important to broaden the horizon and think beyond a bank, borrower, and the default that particular borrower can do on the loans taken by the borrower. This is very, very important, and this is the point that I wish to emphasize. Now let me move ahead and tell you that what could cause credit risk. So credit risk is caused by credit events. Credit events can be of many type. Okay, for instance, you can have the extreme form of credit risk where a business files for bankruptcy and it says that I'm not able to fulfill the commitment of repayment. I cannot repay my loans to the extent I was supposed to pay. So I'm moving ahead and I'm filing for bankruptcy. Remember, even in India, uh, as per insolvency and bankruptcy code, there are three entities which can file for bankruptcy. One is the financial creditor. Any institution that would have given the credit, which is a financial credit, can file for bankruptcy. Second entity is the operational creditor which can file for bankruptcy. So all the credits are not financial in nature. There are some credits which are operational also in nature. So the operational creditor can file, and the company itself can also file saying I'm not able to repay. Company here is the business entity. So credit events could be filing for bankruptcy. It can also be in the natural course of the business, because businesses not always fail uh, just because of the fact that there was a fraud or there was some kind of a bungling that happened in the business. Okay, so when Netflix started growing up, okay, and it became a big player, its competitor collapsed. Okay, we see how telecom companies in India are struggling because of changing business dynamics that we have experienced in the recent years, because predatory pricing has badly impacted some of the businesses. So filing for bankruptcy could be uh, one credit event. Payment default, which is most easiest to understand, and that is something that we may come across very frequently in our day-to-day life, where we may read newspapers and watch television and see that one of the party to the transaction has failed to repay. In the COVID world, we are also experiencing many small borrowers not being able to pay because they do not have sufficient cash flow. And finally, there can also be a debt restructuring that can happen. I mean, some borrower would have borrowed, say, example, 1,000 crore, it's not able to pay. So what happens is that there is a negotiation that goes on between the borrower and the lender, and the debt is restructured and it can get converted from debt to equity, whereby some amount of debt gets reduced and the lenders become owner of the business to some extent by buying stake in that business. So that's the context of debt restructuring that we need to understand. So all these are credit events. Remember, default is an extreme form of credit event. It does not always start with default. I may not be able to pay on time, so first I delay the payment, but I still pay it. Next time the delay becomes longer, and then comes a stage when I'm not able to repay. So it does not happen that everything starts with a full default. We may have delayed payment, and then this there is an indication of the fact that there is a credit risk which is getting built up because of that. Moving further, let me tell you all that if you go to some of the banks website, they have given the types of credit risk and defined it. This is the one which I found on the Deutsche Bank's website, and I can tell you that here, as you can see, there are 5 types of credit risk which have been mentioned. So earlier, what we saw was the credit event. Now what we are saying is the type of credit risk. So first is the migration or the default risk. What is the meaning of credit migration? Credit migration means when the rating of a borrower starts moving downwards. Okay, that is a kind of a warning sign for the lender. But migration does not always happen on the downside. You may have been rated, for instance, triple B, and you get double B rated. That's a credit migration. But from triple B you can also improve. Okay, so there can be a credit migration that can happen for better, and there can be a credit migration that can happen for worse. Here we are referring to credit migration which is on the downside. Okay, so credit migration risk is where we get to know about the indicators of risk when the rating of a business starts moving downwards. That goes on to show that the ability to repay is now under question mark. The second is the country risk. Many transactions happen internationally. Two businesses may borrow and lend with each other in the global framework also, in terms of one borrower being in say in Japan, another borrowing being in an African country, just as an example, or maybe Japan and US also. Okay, of course in Japan and US case the credit risk will not arise because of the country specific risk, but country risk is the risk that otherwise solvent and willing counterparties are unable to meet their obligation due to direct sovereign intervention or policies. So if the government puts some kind of a blockage in the transaction process or put some kind of a restriction on the transaction, there may still be the credit risk. What else? You can have the settlement risk. Settlement risk is a huge risk. Settlement risk is a risk because of the reason that the parties which are supposed to make payment are not able to pay. As we know, not all transactions get settled immediately on cash basis. There may be a time lag. Like when you trade in securities market in India, there is a T+2 settlement cycle. So you transact on T day, but the transaction settles on the second day. So between T day and T+2 day, what if there is a non-payment by one of the parties? That will create the settlement risk. As has been defined in this case, settlement risk can be put as the risk that arises from any existing, contingent or potential future positive exposure that you may be having. So it is also considering the contingent liabilities which are typically outside the balance sheet, and that has been mentioned here. Then many times we as business entities will try to, or as a borrowers will try to, or as a lender also will try to reduce the risk and put the mitigation plan in place. But what if risk mitigation measures don't perform as thought of? If in that case what will happen is that you will face the mitigation risk. And finally, a very important aspect that we should not forget is the concentration risk. Concentration means what? When your loan portfolio, for instance, has got selected borrowers from a sector, then you have the huge concentration risk. Now this concentration risk can be very, very damaging for a lender, because if one sector starts performing badly where the lender has huge exposure, then it can become a problem for the lender. So essentially we can look at credit risk in terms of the different types. I'm not saying that this could be the only way to put it, but definitely one of the best way to put different types of credit risk is this, and that's why I thought I will take the information from there and share it with you. I will move ahead from here. I hope you all are getting the concepts clearly. Now moving further, let me tell you that credit risk can happen in different industries, sectors, different domains. I can say banking is definitely one area where credit risk is very, very obvious, because banks are in the business of lending money. But it can also happen in capital market. Capital market is a place where securities are issued, traded, transacted, and there could be a risk which can arise. Insurance companies also may face credit risk. 2008 crisis was a classic example of insurance companies, how insurance companies were bailed out during that period. Okay, so it showed that a huge risk has built with respect to insurance companies also, and it could have kind of become very serious had timely intervention not been done at that stage. There can be risk which may also arise because of operational credit. Please understand that all loans are not always financial in nature. I may have suppliers who are giving me goods on credit, and I may not be able to pay them on time. That's also a credit risk, because we know that in the balance sheet, creditors are one of the liabilities which appear under the current liability, and creditors also are the entities who have the risk of the borrower or the entity which has taken the supply not paying them on time. And then we can also have country specific risk, something that I have already elaborated upon. I will move ahead from here and tell you that we have the credit movement that happens, especially in the banking system. There is a provision to measure the movement of the credit quality. Okay, and that's why there's a classification of assets framework which is there in place. In India, RBI has made this framework. So as per this framework, you will find that we have three types of assets in terms of their classification below the standard quality. So assets could be of standard quality, but they need not always be standard in terms of the payments. Standard assets are assets on which the payments are being made, periodically, and up to 90 days of delayed payment is also accepted. But if you see the further classification of it, in terms of substandard assets, RBI very clearly says that with effect from March 31st, 2005, a substandard asset would be one which had remained NPA for not less than or equal to 12 months. Okay, so if an asset becomes non-performing asset and remains non-performing for a period less than or equal to 12 months, it will be classified as the substandard asset. So an asset moves from standard to substandard. Okay, so that's how we put it. The next classification is from substandard to the doubtful category. So earlier the asset was standard. Now after that it became substandard, and then with effect from March 2005, RBI again says an asset would be classified as doubtful if it has remained substandard category for a period of 12 months. So if an asset remains substandard for 12 months, after it has become substandard, okay, then it will be classified as the doubtful asset. And then you have the third classification, which is called as the loss assets. Okay, so what does it mean? A loss asset is where loss has been identified by the bank or internal and external auditor or RBI inspection, but the amount has not been written off wholly. In other words, such an asset is considered as uncollectible and of such little value that its continuance as a bankable asset is not warranted, although there may be some salvage or recovery value. So then you classify the asset as the loss asset. Okay, but what happens from the period of 0 day to 90 days, that also needs to be understood, because we have the substandard asset, the asset moves to substandard category after 90 days. So from 0 to 90 days, as per RBI's guidelines, there is a provision for a special mention accounts. So the moment the payment does not happen, okay, where the principal or interest or any other amount wholly or partly has been due, then RBI puts assets into three categories up to 90 days. They are SMA 0, SMA 1 and SMA 2. So SMA 0 means the payment has not, either of the principal or interest has not happened up to 30 days, 1 to 30 days. Then SMA 2, 30 to 60 days, SMA 3, 60 to 90 days. If it is a revolving credit, then it is 31 to 60 days and 61 to 90 days. So special mention accounts basically help in understanding what kind of a stress that is getting built into the banking system. Because see, if a borrower is not paying for 90 days, you just cannot wait for 90 days to say, okay, now the asset has become substandard. No, it's not that way. You keep on monitoring the position of the asset also periodically. Look at it as SMA 0, SMA 1 and SMA 2. That classification also has to be done. So this will give an insight about how is the asset in terms of its quality. So having looked at two aspects, the first one was that we looked at what's called as the substandard the doubtful and the loss assets. We have also looked at the SMA status. Let us move ahead and now think about what could be the factors that cause this credit risk. Obviously, we need to know factors which could be there. So, there could be many factors. I've just listed down some of them. They could be driven by internal factors as well as external factors. So, let me first talk about the internal factors, which are very obvious, because this is something where a bank can probably work much than the external factors and try to mitigate the shortcomings which may be there. So the first aspect that needs to be looked at from the internal perspective is that you may have a poor credit appraisal process. When the bank is doing the credit appraisal, there are not adequate consideration put in place for credit appraisal. You are not actually evaluating the borrower correctly and giving the credit without properly evaluating the borrower. So, the details of the borrower, the financial position of the borrower, the future business prospect, if it is a business loan, all those aspects need to be looked at. Okay. Again, when the borrower is borrowing, the borrower may belong to certain sector, and the bank may have huge exposure to that sector. So that kind of concentration risk, as we spoke earlier, also comes into play here. So exposure to certain sectors or industries, which suddenly have issues like post-COVID. The hospitality industry has huge issues and they have loans outstanding. So the question being asked is, will they be able to repay those loans? But not in all honest assessment, let me tell you that nobody could have predicted COVID, but then the risk has definitely got created. There can also be an issue of poor post-lending monitoring mechanism. It's not good enough to just give the loan and say, I gave the loan and I had all the checks and controls in place. A loan can be, say, a 5-year loan, a 10-year loan, or a 2-year loan. So the monitoring also needs to happen, on a consistent basis. If you have inadequate recovery mechanism in place where the bank is not proactively recovering the money from the borrower, then also there could be another problem which will arise. That's the internal factor that would cause it. And collateral valuation issues are also there. It has been seen that many times banks give the loan, they have the collateral, but when it comes to the recovery process, the collateral cannot be sold because of a lot of issues. Maybe a liquidity issue, maybe the entitlement issue of the collateral, who is the right owner of the collateral. All such issues may come, and the personal guarantees also banks have not been able to invoke, just as an example. So these are all the factors which I will classify as the internal risk factors. What about external risk factors? Interest rates rising, businesses will be in trouble because they may have a huge loan already in the books. When the interest rate rise, the interest costs go up. Changing industry dynamics. We have seen how some of the industries undergo change significantly. I just gave earlier the example of telecom industry, but not just the telecom industry. There are many other industries where there has been disruption because of the technology coming into picture. Change in the government policy. If government suddenly carries out a change in its policies, brings in a new taxation or any kind of a control on that industry, there can be a challenge. Sudden shocks like COVID. It's very important to understand that an event like COVID, which is difficult to anticipate, can happen, but COVID could be an exception. We have a lot of other events which have happened in the past, like 2008 financial crisis, where many borrowers defaulted. International factors such as fluctuation in the foreign exchange. If a business has borrowed from outside the country and the country's currency value depreciates, then that could be a risk. And also very important factor to understand, it will be difficult for banks to gauge it always, that there could be fraud by the promoters as well. Okay, so these are the factors that would drive the credit risk. So let me move ahead and then tell you that it's very important also to understand that we have two types of credit facility. We call them at fund-based and non-fund based. Now, what does this mean? In a fund-based credit facility, the borrower gets the money from the bank, okay? But non-fund-based credit facility is more of an obligation to fulfill. It's like a contract that you are doing, and the bank gives a kind of a guarantee, or bank takes an obligation on behalf of the borrower to fulfill the commitment. Okay, so there may not be any payment that will happen when the loan is availed, but there may be a guarantee, like a bank guarantee or like a letter of credit which may be there. So why do we need to know the types of credit facility to understand the credit risk, because it's the nature of the credit facility that defines the risk that a bank will face. For instance, if I give a home loan to a borrower, there is a collateral which is there, which is the house. But if I give a personal loan to the borrower, there may not be a collateral which will be there. So the risk profile will change. Similarly, when I give a working capital loan for inventory, there is a collateral which is there. There may be another collateral that the bank may ask for, but the inventory may not be sold, and it will be difficult to realize the value of the inventory, because inventories are subject to their valuations are subject to market risks which will be there related to that particular inventory. So why are we focusing on fund-based and non-fund-based facility? It's very obvious that we need to understand the risk profile of the credit facility that a bank is extending, and that's why you need to go through the type of loans. So I have listed them down. Obviously, working capital loans are given for shorter period. It could be also a kind of a revolving credit that can be given, while term loans typically could be given for longer period. It is typically to buy an asset. So longer period loans, credit risk could be higher. Shorter period loans, credit risk could be less, because the prospect of the credit quality deteriorating is less in the shorter is less in the shorter period than in the longer period. Similarly, home loan versus personal loan, you know that there could be differences in terms of the collateral which is there. So personal loan is probably the most riskiest of the loan, because it is not backed by collateral. That's why banks are very conservative in lending, and their recovery can be poor, especially when events such as COVID happen. Okay. Now, when we refer to the non-fund based credit facility, they are bank guarantee. Bank is giving a guarantee on behalf of the borrower that it will fulfill the obligation. Okay. So the guarantee is being given to the other party. There is a counterparty to whom which guarantee is being given. Like, many brokers avail bank guarantee for trading in the stock exchange. So they go to the bank, put a collateral with the bank, and the bank gives a guarantee saying that if the broker does not pay, the bank will pay on behalf of the broker. Okay, so that's a bank guarantee. Here there is no payment which is being made. It's just a guarantee, but there can be a risk in this also. Okay, there was a incident which happened recently, that the fixed deposit receipts were being misused by the brokers to avail the bank guarantee from the banks. And letter of credit can also have its own risk, because this is a transaction which is mostly cross border. So if it's a cross border letter of credit, the other party may not pay, and there could be a risk, because multiple banks are involved in transaction. So we need to understand the type of credit also in order to get an idea about the credit risk. So before I conclude, I will just like to tell you all that, in this video, we could get a couple of aspects very clearly. What is credit risk? What is the type of credit risk? Or rather, what are the types of credit risk that a business may face? What are the factors responsible for that? Okay, and how do we look at the different types of loans and their credit risk, which I briefly covered. I hope you liked this video. If you have liked this video, please subscribe to my channel, and just put the comment in the comment box if it was meaningful for you. Thank you so much for your patient listening. Thank you.